So obviously a lot of questions from market participants as we move into the new trading week about the potential for a US government shutdown. Federal funding due to expire at midnight Wednesday morning Eastern time at the moment. And it certainly doesn't look like things are going to get resolved before then. Although the Democrats in Congress and President Trump are now due to meet, progress is likely to be somewhat elusive. Of course, this raises the question of what does it all mean for financial markets? And to be completely honest, the short answer is not a lot. In the prior shutdowns that we've seen, the S&P has pretty much been flat throughout all of them. The government has shut down 21 times in the past, and the average return in the S&P is 0.1% during those shutdown periods. From a macro perspective, in terms of economic growth, you would imagine as a sort of rule of thumb that every week of a shutdown would knock about 0.1 percentage points off US GDP. But before you start to panic, that growth would then just be recouped in the following quarter when the government reopens. Perhaps the biggest impact for participants and policymakers alike is that if the government does shut down, then key economic data such as the Friday's jobs report and potentially even things like the inflation and retail sales figures that are due in a couple of weeks' time could end up being delayed, which does mean that the Fed and market participants could be flying somewhat blind as we move into the month of October. But the long and the short of it is that while the government shutdown is good for taking up column inches and it certainly keeps the politicos out there busy, for market participants it's really just noise and not much by the way of signal.